Hey guys, it's Imran from Options Insight again. Time for another update. Obviously, we've had a pretty epic sell-off on Monday. S&P down around 12%. Just a major crash across all global markets. What is it? What triggered it? What happened? Well, obviously you had that Trump press conference on Friday that drove markets up, and they closed up about 10%. And then over the weekend, you had the Fed announce 100 basis point rate cut and a crazy large stimulus of about 700 billion, I believe it was, to kind of QE starting again, basically. So this is proper Armageddon 2008 type measures they're rolling out. And they pretty much showed the market their hand in that, how desperate they are to prop up this market, and they're just throwing the kitchen sink at it. And that, unfortunately, was not received very well by the market, because I guess the market's sense was, wow, if they're panicking that much, then maybe we need to panic. And so after a momentary blip in the overnight futures, the market just got destroyed when it reopened on Sunday night. Went limit down almost instantly, and then on Monday morning when we opened up, Europe had gone on to sell off another 5 to 7%, and it was, what happened, right? It was carnage. So now let's have a quick look at the charts and decide what we want to do from here. I've been bearish. I've been talking about selling the rips. Obviously, that rip on Friday was no different. The Trump-led rip was a great opportunity to sell the market, whether it was loading up on puts or whether it was selling futures. I mean, either would have worked. I'm generally an advocate of using optionality, as you all know, with Options Insight. So, yeah, loading up on April puts was certainly what I was doing on that Friday evening, and that paid off handsomely yesterday. So here's a chart of the S&P. So you can see obviously the collapse we've had. These blue horizontal lines kind of represent some of my targets that I had for the sell-off. We've pretty much achieved all of them now. So we achieved that last one yesterday around the kind of 2370 area. So I took off I'll be honest, full disclosure, I took off all of my shorts. To me, it just felt like the panic has kind of got a bit overdone now in the short term. I'm not saying the market can't go lower. I think it's very realistic that we could see 2200 or even 2000 before this stuff is over. But I do feel like this particular leg down has done enough that we can maybe stage some kind of bounce. So I don't feel the need to be long puts anymore. I took them off. I would be looking for a bounce of the order of magnitude to get us somewhere between 25.60 and 27.20 back into this zone here, where I would then potentially start to play or look for ways to play the downside again. Another sort of risk factor to be aware of is if you own options, if you are playing this through premium, there is beginning to be a lot more chatter in the market about market closure. Apparently the Philippines closed their markets. We know China has a habit of closing markets when it needs to. It's not something that the US do very often. There was a bit of a break in markets after 9/11, I believe. But there's definitely talk about whether or not that is the best. Because remember, if the Fed's bazooka that they just dropped hasn't had the effect that they had wanted, which is to calm nerves, calm markets, calm investors' minds, what's their next move? What's their next play? And you have to think they are considering whether a market closure of some kind is kind of the only way they're going to stop this panic. There's a lot of articles flying around about this, discussing the pros and cons. It is true that if you close markets and there is no longer price discovery available, when those markets do reopen, they could open with a bang, and you could get some kind of crazy 30% gap if you were to do that. So that is one of the arguments against. But then you could also argue that liquidity has evaporated so much, and some of these excess moves are now happening just because of a lack of liquidity and panic and fear being at the highs. So does it make sense for the market to be open? Because this normal price discovery isn't really happening because there's no liquidity for it. So markets are getting moved around by relatively small orders and people panicking. So that there are arguments for both sides. Like I say, because that risk now is there, and I don't know what the probability of it is, but from my perspective, I imagine it's 30%, maybe 30% probability, maybe 30 to 50% even probability that they might shut markets. If they shut markets and you're long a load of option premium, that's not a good place to be. Your option premium is going to be evaporating and turn to worthless pretty fast, right? I imagine, yeah. But like I say, this is all uncharted territory. Even for me, having traded through 2008, I believe this crisis is worse in the way that it's playing out for markets. At least in 2008, when they rolled out QE and they said, right, we're going to prop up the system, the market recovered for a bit. Whereas here, it just got instantly sold to them. So it is a new ball game we're playing, right? So anyway, I'm going to stop rambling on about S&P. That's basically what the S&P chart looks like to me. I've covered shorts. Like I say, look to reload shorts maybe in a bounce that gets us into this territory. I wouldn't really go long. I don't feel it's safe to go long right now. If you go long, yes, you might get lucky and get a 5-10% bounce, but the risk, the unknown is too big, right? The void to the downside is too big. So I'm not in a position where I would want to tactically go long. If you want to start accumulating longs for like long-term pension portfolios and stuff like that, yeah, why not start averaging in, right? We've had a lot of damage done to this market, so you could definitely start to nibble in some long-term bets here. Have your shopping list of stocks that you think you want to own for the next 2 years, and start gradually scaling into those positions. That would make sense. Let's be very clear. This is not investment advice. Yeah, if you do invest on the back of any of the stuff I'm saying, that's at your own risk. You should always check with a qualified investment advisor. I'm just guiding you as a trader. I'm showing you what I'm doing, showing you what I'm looking at. It's not investment advice. Let's be very clear. Okay, what else? The other interesting chart is gold. So gold been battered along with the entire precious metals complex. Actually, silver and platinum are just completely and utterly getting killed. They've dropped about 20% each. Gold chart is still a little bit more rational, a bit more sensible, and you could argue that this sell-off in gold, once it broke this trend line up here, it's kind of gone to correction zones that you may have had. This is the gold rally, right, since 2018. It's fairly clean, that chart, in the way it's uptrending and it's having corrections, and it's still uptrending now. It hasn't broken this level down here, 1450. That was a major level of support which held yesterday. If it were to break that, for me, the next major level of support will be around that 1350 area. If that was to go, then who the hell knows, right? I feel like the fundamentals for gold and silver, but particularly gold, have got much, much better in the face of this, what the Fed has done and what all the central banks are doing, right? They pretty much, the money printing press has gone into overdrive, yeah? So in theory, the fiat currency debasement that is going on should be very, very positive for gold. Now, clearly the price action is not reflecting that. The only real way to rationalize this, and we saw these sort of moves in 2008 as well, was just mass liquidation, right? If portfolios hold any gold, but they also hold other assets that are getting killed, and they just need to liquidate and they need to move into cash, then gold comes off the book as well, right? So you have to assume that this sell-off in gold is led by massive liquidation of portfolios. Is it rational? Not necessarily. From a long-term perspective, it makes zero sense. So you would have to like the chances of gold getting back above highs, maybe even towards 2000 at some stage when the dust settles here and the liquidations are over. And I suspect when gold does start to recover and those liquidations are over, it will recover very, very quickly. Yeah. So will we get more selling? Probably depends on what equities do. If equities have got more downside in them, which I suspect they might have, then we might see 1450 again, and we might be lucky enough to see 1350 again. If we see those, I'm closing my eyes and buying more for my pension book, because gold is the wrong price. If we get down here and literally fiscal spending, QE, everyone's turning the taps on the monetary side, it's only a matter of time before gold has to fly again. Yeah, so that's my opinion there. So definitely an important market to look out for, gold. And like I say, the S&P feels a bit short-term overdone to me. I'd be looking for a bounce before I get short again. And that's the quick, short, and snappy from me. I hope that was useful. And if you like this sort of stuff, don't forget to subscribe to the YouTube channel. I'm probably going to be putting updates like this every few days, just because markets are crazy right now and there's a lot going on. Thanks for watching. Cheers.